Living off dividend income as fast as possible is a huge goal that a lot of dividend growth investors, including myself, has. And even though there are different income-focused investment vehicles across the market, like take some of these yield max ETFs for example, investors like myself that don't want to have exposure to ETFs that decay like crazy, making your total return negative, definitely are staying away from names like these ones. Now in this video specifically, I'm going to go over a portfolio that's made up of two different holdings, which are going to be the JP Morgan Equity Premium Income ETF, or JEPI, as half the portfolio, and the other half of the portfolio being the Schwab US Dividend Equity ETF, or SCHD. Now with this portfolio being made up of half JEPI and half SCHD, this portfolio in theory will generate a ton of cash flow on a monthly basis from JEPI's rather larger than average dividend yields, but also have a ton of dividend growth and upside potential from what SCHD offers. Now if you want to see exactly what this portfolio would look like if an investor went half JEPI and half SCHD, stick around, drop a like down below, and let's get right into it. I just finished my brand new dividend investing ebook where I share exactly how I went from zero to now over 7 figures invested, and also on how I earned more than $6,000 per month in dividends. I also finished my custom dividend tracker that you can use to track your dividend income progress on an ongoing basis. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So first, let's go over the two ETFs that are going to make up this portfolio, dig a little bit deeper into each of them, and explain how they each work. Now keep in mind, both these ETFs are very different. They have completely different strategies, and that's why for an income-focused investor that wants cash flow from day one, but also wants some upside exposure and wants exposure to some of the best, highest quality dividend growth stocks across the market, this 50-50 portfolio could be quite interesting. Now first, digging a little bit deeper into JEPI, the JP Morgan Equity Premium Income ETF. This is an ETF that a lot of you are probably familiar with, but just going over some of the basics, the portfolio for JEPI is a defensive equity portfolio that employs a time-tested bottom-up fundamental research process with stock selection based on a proprietary risk-adjusted stock rankings. Now along with that, JEPI is obviously very, very unique because the fund managers also implement written out of the money S&P 500 index call options, and this is to generate distributable monthly income. Now, a lot of you probably watching this video also sell covered calls within your portfolio. I know I definitely do. And if we know one thing when it comes to covered calls, there is a ton of premium to be earned, which is exactly how JEPI earns so much in dividends on a monthly basis. And speaking of dividends, looking at JEPI's dividends over the last year or so, we can see that the dividends are different on a monthly basis, and this is going to be due to things like volatility in the market and how much premium is being offered on, of course, the S&P 500 covered calls. But in general, JEPI pays around 35 or so cents on a monthly basis, which equates to somewhere of around a 7 or 8% dividend yield, which is not bad whatsoever, especially because of the fact that JEPI does have downside protection and has a very diversified portfolio. So now that we dug into JEPI, let's look at the SCHD ETF, or the Schwab US Dividend Equity ETF. Now this ETF's objective is completely different. This ETF does not have a cover call overlay. This ETF has one objective, and it's pretty simple: to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Dividend 100 Index. Now some highlights for this is that it's a straightforward low-cost fund offering potential tax efficiency. The other main takeaway is that it tracks an index focused on quality and sustainability of dividends. And looking at SCHD's dividends over the long term, these dividends look very different than JEPI's. You can see that over time, dividend growth is definitely apparent, and SCHD has been paying more and more in dividends, basically, more or less, since the fund's inception. Other main things about SCHD, it currently has 52 billion plus in total net assets, which is massive. The expense ratio is 0.06%, which is very cheap, and especially if you're like myself that now owns hundreds of shares of SCHD, you don't want an expense ratio that's too high. Now, before we go a step further, I think it's very important to get this right out of the way. Let's see exactly how much an investor would have made if they were to have invested $10,000 into SCHD, and this is back at the ETF's inception, back in 2011. If an investor invested $10K into SCHD and reinvested those dividends every single quarter, that investor would have had a total return of 343%, or just over 12.7% average annually. Now, there are certain investment vehicles that have returned even more than this on this time frame, but I think this alone garners at least the respect to keep looking a little bit deeper into this ETF, and maybe, just maybe, this ETF is actually worth all the hype, because I don't know about you, but an average total return of 12.79%, with dividends reinvested is not bad whatsoever. Now looking at price performance for both JEPI and SCHD, and this is one of the other interesting ideas of why combining both of these ETFs could possibly be attractive for a dividend income focused investor that also wants some upside potential. Now you can see that JEPI over the last 1 year time frame has grown pretty substantially, up almost 9%, which is impressive, especially for an ETF that does have a cover call overlay, which is normally going to somewhat stunt upside growth. But on the max time frame, JEPI hasn't grown all that much, up 13.75%, and although this is only over the last 4 or so years, this ETF is relatively new, it still hasn't had all that much growth, but that's because JEPI over the long term has paid a ton of cash flow to investors like myself. And you can see that JEPI has paid even certain months over 60 cents, which is a massive dividend paid out on a monthly basis. But this is where it gets interesting. Looking at how much SCHD has grown over time, 10% plus on the 1 year time frame, which is significant. But on top of that, zooming out, SCHD over the past 10, 12, 13 years has grown over 200%, which again, like I said, for those investors out there that want cash flow from day one, but also want to see their portfolio grow and grow and grow, SCHD is a great ETF to look into. Now, just to be clear, let's not also discount the fact that SCHD does also pay a pretty juicy dividend, 3.3% on the last trailing 12 months. And this is because this ETF has grown a lot over the last few months. But like we touched on, even though you're going to be getting, let's say, a 3.3% starting yield with SCHD, it doesn't mean that next year isn't going to be higher, and the next year after that isn't going to be higher than that, because over the long term, that's exactly more or less what's happened. The dividend growth has been significant with SCHD, which is very, very attractive to long-term investors. So at this point in the video, you might be asking me, well, if SCHD has grown over time, also pays a nice starting dividend yield, but on top of that has also had significant dividend growth, why would you not just invest everything, 100% of the portfolio, into SCHD rather than even messing around with JEPI in the first place? Now, I would say that's a good point, but it totally depends on what you're looking for as an investor. Some investors are more interested in earning more cash flow from day one, which is perfectly fine. And even though you might get some bigger total return, more upside potential with other ETFs out there, such as SCHD, the VOO ETF, or even the S&P 500, some investors, including myself, are okay with a little bit less total return if it means that we're going to get paid bigger and bigger dividends from day one. And that's exactly why I think, in theory, a portfolio made up of half JEPI and half SCHD would sort of cross off everything you're looking for. If you are a dividend growth investor, like I said, that wants exposure to some upside, wants to see their net worth go up, wants to see their portfolio go up, but also want to utilize something like JEPI so they don't have to wait too long to get cash flow coming in from day one. Now, in the hopes to be completely, fully transparent, this is basically what I've been doing for my long-term portfolio. And as you can see right here, this is my dividend tracker, which shows basically every single position ongoingly that I'm adding to my portfolios in real time. Now in this portfolio, you can see that I have 2,700 plus shares of QYLD, but I also have 1,000 shares of Apple stock. And even though my strategy is not necessarily the quote-unquote right strategy or the best strategy, for me personally, I want to build a portfolio that has the potential to grow over time. But also, I want to build a portfolio that gives off cash flow from day one. And because that's my basic investment thesis, I've been trying my best over the years to build a portfolio that completes that equation perfectly. Another example in this portfolio, I currently have 575 shares of SCHD, and I also have 1,248 shares of JEPI. Now, throughout this entire portfolio, even though I earn north of $6,200 per month every single month in dividends, that doesn't mean that this portfolio isn't also going to grow over time, because like I said, I do own things like Apple, I also own things like Realty Income, and even Devo, which do have the potential to grow in share price. But now lastly, I want to ask you guys down below, if you were to build a portfolio with just 2 positions, one position offering some growth and one position offering some yield, which 2 ETFs would you pick and why? Drop it in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.